Good morning, dear clients, and welcome to today's webinar from Norron. My name is Stefan Meyer. I'm the CEO of Open Funds. We have two portfolio managers from Norron on the line with us today. Markus Pleer, he's the head fund manager for absolute return products, especially for Norron Select and Norron Target, the two funds we're going to talk about today. And Oskar Sjögren from the same team. He's the portfolio manager for derivatives and quants for the absolute return products. Before we start, just a few housekeeping items for today's webinar. We will kick it off with a presentation on Norron Select by Markus and Oskar for about 20 minutes, followed by a first Q&A. All participants will be in listen-only mode during the presentation. For the Q&A, we will unmute everyone, so you can ask questions by using the panel of the GoToWebinar, which is, I think, sort of in the right-hand corner of your screen now, where you have a little button with a microphone sign. Simply press the hand sign, then if you want to ask a question, and unmute yourself, and then you can ask the question. After the first Q&A, we will have a second but shorter presentation on Norron Target, and then we will also have a second Q&A. We will record this webinar and send you the link to the recording and the slides after the presentation. Before I hand over to Markus, I just want to tell you why Open Funds is happy to work with Norron. We like them because the Nordics are an interesting part of the global equity market. Their return has been 11.1% since 2003, so an excellent performance, outperforming Europe by about 3.2% per year. So it's a very interesting part of the global equity market. Norron is a true alpha generator. By combining good stock picking in the Nordics in both the long and the short book with a dynamic downside protection of the portfolio, they were able to generate 7% annualized since inception in 2011 for Select, with only 8% volatility. And that compares to the MSCI Nordic index with an 8% return, but 17% volatility. And that results in an excellent Sharpe ratio for 1.0 for Select, as compared to 0.6 for the MSCI Nordic index. So a really very impressive achievement in terms of risk and return. And Norron is partner owned, so they have skin in the game. All their PMs are partners and hold about collectively 57% of the company. The remaining 43% are owned by Kjell Ingen Røkke and his company Arca Solutions as an anchor investor, giving some stability to Norron on top. With this, over to you, Markus.
Thank you, Stefan, and thank you everyone that's listening on the call. So before we go into the Norron Select Fund, I will start presenting myself, and then Oskar, the co-PM for the Absolute Return Funds, will present himself as well. So my name is Markus Pleer. I've been at Norron for almost 10 years. I started as an analyst and then advanced into a portfolio manager role the last 6 years. I've been part of the investment team since the beginning. Before Norron, I was working for a hedge fund in the United States, working as an analyst and portfolio manager assistant. And before that hedge fund in the US, I was working as an analyst at a venture capital company 2 years during my studies in the States as well.
And my name is Oskar Sjögren. I've been here at Norron for 5 years now. I'm in charge of the derivatives and the quants. Before joining Norron, I worked at a Swedish bank as a equity or option market maker. Yeah.
Thank you, Oskar. And like I said, before digging into the Select Fund, we just want to give you 5 minutes briefly look where we are in the market right now, because we think the market is very intense and it's interesting, especially through a hedge fund perspective. So looking at the short-term perspective, we have seen the market bounced the last couple of weeks, almost 10-15%, and we pay a lot of attention both the short term but also in the long term. So we are sort of tactically increasing and decreasing the exposure in the hedge funds depending on where we think the positioning and the current sentiment in the market are. And usually when sentiments has troughed, usually that's a good indicator when the market will trough as well. We pay a lot of attention to very many different factors, but looking at this picture over here, we have seen we're still in the low range in short term, where risk are reduced globally, both through hedge funds, but also quantitative funds and general risk segments. That being said, we think the market could be strong going into year end, but then in 2023 we will still have a difficult year ahead of us, and we think hedge funds and absolute return funds would be an excellent part of an allocation and a portfolio going forward.
Yes, and like Marcus said, we have these pictures are actually 2 weeks old, but you can see on the left side, you can see that people actually started to increase their exposure even in September. So this like we saw in the sentiment that Marcus said, that people have started to increase their exposure, and people have also started to sell. If you look at the top right corner, you can see that what you can say that people have been hedged all along, and now that they're starting to realize some of that gain, and they do that through put selling. And what put selling does is that it decreases the volatility, and that pushes the markets up again. And so that's what we have been seeing. It's still going on. People are not afraid of the downside at the moment. Like you can also see that through the skew. Skew is what you pay for. You can compare how expensive a call is or a put is against a call. And if you look at that bottom right corner, you can see that people are not afraid at the moment of the downside. They're more afraid of the upside, and that's why we're seeing these sharp moves to the upside at the moment, if you just look at the volatility space.
Thank you, Oscar. Going forward, we will be talking maybe 15-20 minutes about the Norron Select Fund, which is a Nordic long-short equity fund. So Norron Select is an actively managed, sustainable long-short equity fund in the Nordic region. It's daily traded, and the fund is managed as an Article 8 fund and has been reporting with compliant to the EU taxonomy the last 12 months. The fund has more than 10 years of track record. The inception date was in February 2011, and we had great stability with the team. Myself, have been with the fund since 2013, and as you can see, we have almost received stock market returns, but with only 50% of the risk. So since inception, the fund performance is somewhat above 7% with a volatility of 8%. So we're aiming towards a Sharpe ratio about 1. Comparing to the MSCI Nordic Index and comparing to the MSCI Europe Index, we have been able to deliver great adjusted returns. Looking at the correlation compared to the different indices, the correlation has been below 0.5 in both of the comparisons, and looking at the beta, which has been around 0.4 since inception. And what I would like to highlight here is during times of market stress, like during the debt ceiling crisis in 2011, we were able to mitigate that and have a stable return when the market was down 25%. Same goes with the turbulent oil crisis in 2015. The fund was up, and when the market was down about 20%. Same in 2018. When the market was down maybe 25% at the end of Q4 2018, we were able to have a positive return that year. The fund only have recorded 1 year of negative returns in the last 11 years. So looking at how the different investment strategies and how we divide the long book compared to the short book. In the long book, we can find 3 different strategies. As the fund is a UCITS regulated daily traded fund, we are able to hold up to 10% of unlisted holdings. Today, we have approximately 5% in this strategy. The next strategy is what's something we call the core case small cap strategies. As the fund has been participating in small and mid caps since inception, we have delivered great alpha returns in this type of strategy. In average, the fund has been holding between 25 and 30% of core cases, and we believe that in the Nordic region, the small and mid cap space is very interesting and have been delivered great returns over the last 10 years and longer than that. And how we looking at the next strategy, which is something we call the directional strategy. Pretty much this is the beta part, where we take on either cash equity positions, but also long book derivative strategies. So for example, if in a way we're using derivatives is to reduce the risk in the fund. For example, if we hold a cash equity position in Atlas Copco, the big industrial company, I would like to reduce that position. I could switch that cash equity option into option strategy in order to reduce the risk, because if the market would go down and Atlas Copco as well, I know my downside due to the option premium paid, but also we get the leverage on the upside if the market and Atlas Copco would go up. Looking at the short book and how we're hedging this long book, 2/3 of the short book is contained by the index hedge, and this is done on OMX, Swedish futures and Swedish option strategies, but also Eurostox futures that were short to reduce the beta. And 1/3 of the short book strategy is contained of single stock shorts, where we take active bets for stocks to go down. And looking at the turnover ratio in the short book, especially the single stock short book, we have a lot of higher turnover ratio due to the fact that we are shorting companies where we see triggers ahead of quarterly reports or downward revisions and part like that. What we have seen in 2022. The greatest alpha contributor is in the single stock short book, where we have been playing different themes during the year, from high multiple companies to real estate companies to consumer goods, consumer exposure companies. And this sort of narrows down to the risk, the overall risk in the fund, which is the net exposure and also the gross exposure. Looking at the next strategy, where we do our tactical allocation, and this is a combination of top-down approach, bottom-up analysis, depending on the alpha generation in the long book and the short book, and also dependent on the prevailing market conditions. So this is applicable towards the whole Norron Absolute Return Fund's mandate, because we look at things like I said, the net exposure, the gross exposure. Oscar will go into more in detail in looking at the hedging profile, and then for the other fund, the other low risk multi-strategy fund, we look at the allocation towards the fixed income part, and also where we in the Norron Select Fund we look at the allocation into the 3 different sub-strategies, like I said, the unlisted bucket, the core case bucket, and the directional beta bucket. And then we also, as we are part of volatility management and the derivative space, we are very, very focused on looking at the gamma profile on both the short book, but also the long book. Looking at the investment process, where we think is key here at Norron, because we're not working as a independent silo, each PM for themselves. We're working more towards a team-based management and team-based investment team. So we do weekly investment meetings with the whole investment committee. From the top, our CIO Ulf Frykhammar, and all the various PMs, and also including the head of ESG, Clara, in order to get her sort of view in the investment process and in the companies we're investing in. And what things we could be discussing on those meetings are, starting from the left, the macroeconomics. What are the overall trends? What trends are sort of working and not working? We look at the different markets, looking at the fixed income market, looking at the equity market, looking at the volatility market, and different parts of asset allocations. We pay a lot of attention towards how is the positioning and the sentiment in the market. Not like we said in the beginning, the short-term positioning is very important, but also the long-term positioning, because what we have seen in the last couple of weeks is the short-term market has been sort of de-risked, but also in the long term we still see equity flows going into equity funds, which is interesting when we're going into 2023. But we will talk more about this later. And then we highlight all the companies and go over all the investments in these weekly meetings. We look at the company specifics, we look at the different trends, and also we look at valuations. And every week we are having PMs pitching ideas that could be beneficial for different funds. And then we've been putting more emphasis towards ESG. We talk about company incidents. We have a ESG watch list where we can and cannot invest in companies, and then we look at the current regulations and where the winds are blowing, talking about the sustainability part. And this boils down into the net and gross exposure. We decide how should the sub-portfolio exposure be in those three different sectors, sub-portfolios. We look at the different underlying portfolios and strategies, and then of course the company specifics that I talked about. But in the hedge funds, because of looking at hedge funds, risk management is an essential part. That's why it's so important for us to understand and know where the risks are in the different mandates. Looking at the investment process for the long book, and here you can see that we are mentioning more than the 3 long book strategies that Norron Select holds. This is because this is applicable towards the whole investment team and the whole all the mandates within Norron. But what we look at when we take on new investments is we do a subjective assessment. We look at internal and external strategies and how the management team has performed in each company we own. We also look at an important part is look at the cap table and the ownership of the investment we take on, because is it a capital strong owner, and how will the different owners react due to different parts of that investment. Then, as Norron is a fundamental house and we do a lot of fundamental analysis, we look at financial reporting every quarter. We talk to the management teams every quarter in order to understand their feeling and their goals within the company we're investing. We look at future estimates and we look at different trends. And for the large cap names, we talk to external analysts with both local banks but also non-local banks in order to get their understanding of the different companies. For the small cap names and the core case strategy that I was talking about, we build our own models in order to have an edge when it comes to the other investors, and also when we have an edge when it comes to external analysts out on the street. And of course, we look at the valuations and peers when we analyze the different investments. And then, like I said, ESG is an important part, and many think that ESG is just something you have to do and then pretty just a must do, and not anything else. But we think that ESG will become an important part going forward. We think that companies with a good and great sustainability model and sustainability approach will have a higher valuation in the years to come. So we see this an opportunity instead of a risk. And then look at how sort of when a position has already entered the portfolio after the selection process, and how do we own the position. Of course, we do semi or quarterly company meetings. We talk to different analysts. Like I said, we look at the different estimates, revisions, and we monitor the position, of course, on a daily basis in the fund, but we talk to the management teams and the companies on a quarterly basis. And then also, of course, short and long-term triggers is important, because on the long side and long book, the long-term triggers and are more important than the short-term short book, because then the short-term triggers are more important. And then we overdo sort of, we have a macro overlay in order to see if there is any risk. For example, like I said, the Atlas Copco example for the industrial company, that industrial company is of course dependent on how the macroeconomics are in the world. That being said, Oscar, do you want to briefly talk about the short book?
Yeah, sure. So we have, like Marcus said, we have different types of instruments in our short book. We can characterize them as macro hedges and then more specific hedges. Like you said, we have index futures and index derivatives. That's on OMX, the big Swedish index, and then the more known Euro Stoxx 50. We also have volatility strategies, where we bet more or less just on the volatility going up or down. Then we have single stock shorts, like Marcus said, and then we have factor hedges. But what we do, I think we're going to talk about this more later, but we screen our portfolios on different types of factor exposures, and if we think we have a too large or too small exposure to some factor, we can correct that using different type of baskets. Yes, that's it.
Good. And then looking at the short book, we depending on how the long book are sort of built, we're mapping the short book towards that, either through index futures or like Oscar said, the factor hedge and option strategies. And then we every week, and if not more often, we do scenario analysis and stress testing the funds. And we think that, I mean, as the fund is not just a beta 1 play, and more so a derivative also part of the portfolio, it's important to understand the Greeks in the portfolio. So we pay a lot of attention towards the gamma exposure, the vega and the delta in the different option strategies we hold. And of course, we look at value at risk. And then depending on what type of exposure we will have in the fund, we could be sort of adjusting this with derivatives, futures, going into a tactical trading risk management process, and that sort of boils down into how we're adjusting the risk in the fund. Looking here at page 15, we can see the net exposure and the gross exposure. As you can see, the orange line is just a pure beta 1 net exposure, and that has been sort of dynamic between 0 and 100% the last 11 years. And looking at the black line, which is the beta adjusted net exposure. So the beta adjusted net exposure has been around 30% over time in average. But as you can see, in 2011 and 2012, the fund held a negative net exposure during almost a year. So the fund can go short and can be participating and showing positive returns when the market plummets. And currently we've been adjusting the net exposure quite frequently, up and down, as the market turbulence is creating opportunities. This is currently, we are not in a long-term overall. The positioning in the market is not sort of for a long-term person, a long-term investor. It's a trader's market. That's why we pay a lot of attention to the different sentiments in order to gain directional upside, but also reduce the downside when the market goes down. So we're very, very active currently in order to benefit our investors.
Maybe you can just say that it says that you're actually negative exposure right now, but that's not.
Yeah.
This is not an update. This is at the end of August, right? So
exactly.
Right,
so we have we've been increasing at the end of September. We added exposure from 0% up to 30% approximately, and now like I said, we think it's not very uncommon if the market will go up here going into year end, making it even more difficult starting in 2023. And as you can see, we've been reducing the gross exposure, which is the gray line, from about 230% down to 150%. This is because we would like to have sort of an easier portfolio during times of stress. When there's times of stress, you should have not a stressful portfolio. You should have a portfolio that could be easily managed and easy to sort of trade with. That's why we have been reducing the gross exposure in the last couple of 12 months, I would say. Looking at another part of the risk management process and how we have been trading the different sub-strategies. So we've been reducing the unlisted holdings. We've been reducing the core case. Since the last 12 months, we've been reducing the beta strategy as well, but we've been increasing the beta strategy the last since summer. Excuse me. And what we've also been doing is to trade around the single stock short book, which is the gray bars here, and then we have the index hedge, which is also where we're also very active within. Oscar.
Yes, like I said before, we monitor the factor exposure on the funds. What you can see on the right side here is a distribution of the exposures. It says Z score there, but it's not actually true. It's exposure. So yeah, this is what we monitor every week on these meetings. And if we like what we're seeing, we don't do anything. But if we think the exposure is too much or too little, then they correct that using either factor baskets or in the long book.
Exactly. So what we're using the factor, it's more like a risk management overlay, and we're not investing per se through the different factors. And looking at the correlation towards the funds, the Norron Select funds correlation towards the equity market. As you can see, and as I said, the overall correlation has been around 0.5, somewhat below 0.5. But when there's times of financial stress, the correlation towards the equity market goes down to 0 and almost negative. And this is because we're using the derivative strategies in the short book, where the net exposure quickly decreases and the risk in the fund quickly decreases. and we think that's plays an important role when we look at this portfolio and this fund over time.
Yes, and another big part of the risk management is to simulate the options Greeks, like Marcus said before. Here we have two samples of how we do it. On the left side, you have the net exposure of how the net exposure is in the select during just on the upside and the downside. On the right side, you can see the gamma profile. So it's at somewhere around 6%, and this also not only on price moves but also on volatility. So if the volatility goes up, we can see how the net exposure and the gamma exposure changes in the fund. So this is a very important tool for us to actually monitor the very important Greeks in the fund.
Great, thank you. So just to give a short summary and concluding remarks of the Norron Select long short equity fund. So it's an actively managed sustainable fund, and we have been reporting through the EU taxonomy, and it's an Article 8 fund looking at the SFDR taxonomy. We have more than 10 years track record. We had a stability in the fund management team. I've been part of this mandate for almost 10 years. We have been achieving more than 75% of stock market returns with 50% of the risks. And we think Norron Select is a great alternative towards equities. We've been having a low correlation towards stock market. We have limited drawdown risk, and we have been achieving competitive risk-adjusted returns with a annual growth rate of above 7% and with a volatility of 8%. So we have been posting high risk-adjusted Sharpe ratio returns. Thank you. That was the Norron Select Fund. Now we're going to open up for some questions.
Exactly. Thanks, Marcus and Oscar. So for the Q&A, there is on the control panel, there is the unmute section and the hand sign that if you want to ask a question, so that we can see it as organizers if somebody wants to ask a question. There's one from Dara to kick it off.
Hi, Marcus. Hi, Oscar. Thanks for your presentation. Can you? I saw that you've been reducing your net exposure pretty considerably during this year. Where do you expect that to move within the next year or two? Are you expecting to stay at these exposures, or is that something that you're planning to increase going into the new year?
I can take that. So what we have been doing the last month actually is increasing the net exposure. It's around 30% at the moment. So our strategy going into year end is that this could still have some legs, this upside that we're seeing in the markets, but we are preparing for a sharper decrease in declining in 2023 in Q1 in the beginning. What we're seeing is that people are not hedged at the moment, so the system is very vulnerable to the shock. So if there is a shock to the system, then the market could go into a big nosedive here. So that's what we're seeing at the moment. But we have also seen in the beginning or in the end of September, we saw a high. If we're looking at the VIX, we saw a 30% VIX index. Now it's down to 24, and that has also fueled this market going up. That's at the more normal level than we've seen before. So I think we can see sort of a slow grind up to year end, and then we can see we are positioning for a more uncertain Q1 in 2020.
And to add on that, we have the CPI figures this afternoon in the US, and that could also set the stage for if the market is going to continue to go up or not. And of course, you have to adjust when you get new information, and the data points this afternoon will be new information for us, and which we'll consider. But regarding your questions, I mean, it depends how the market, how the data and how the macroeconomics will evolve, because if inflation stays at sort of this high levels within 6 months, the market will not be here. The market will go down a lot, and because then the central banks all around the globe need to continue raising rates. But that will be new information, of course. But when in times of turbulence and stress, where we are right now, I mean, we're writing history right now. You have seen the worst bond market crash for over 100 years. I mean, and the stock market has been so volatile. So that's why we've been reducing the net exposure during the whole year. And I mean, once we see this inflection point, we will start increasing that. But if it's within 6 months or 12 months, I can't tell you as of now. Thank you for that question.
Maybe another question on the long and the short book, just to make it a little bit clearer. Could you give us maybe just one company that is in the long book and why is it in there, and one company that is in the short book and why did you buy it, or why did you short it?
Sure. I mean, looking at the long book, we've been sort of a contrarian, investing in an industrial company, Assa Abloy, making locks, and it's a global company. Looking at that investment, it's currently trading at a very low valuation, and many think, yes, of course, if the market goes into recession in 2023, Assa Abloy will decline as well. However, looking at Assa Abloy, it's the most defensive company out of the industrial companies. During the IT bubble, and during the financial crisis, and during 2012, it was not posting any organic decline on the sales figures. So many think it's a sort of just a macro play, but we think it's more like a structural defensive play going into 2023, as well as where we have seen when there's recession, that's a deflationary setup, and when there's a deflationary setup, as we have seen also, the oil has been coming down, steel prices has been coming down, copper has been coming down from high levels, and when steel prices are coming down, that actually benefits Assa Abloy's margins, the gross margin going into 2023. So we think the analysts on the sell side has been underestimating that. So that's a long position we have going into 2023. Talking about the short position, we are currently short the car, the seatbelt or airbag company, Autoliv, where that stock has been posting highs the last couple of months actually. But we think that the consumer will take a hit in 2023, and the valuation is currently very high, and we think that the market is overestimating the potential going into the next coming years. That's why we're short that stock.
Thanks. More questions from the audience? Maybe then I can ask another question in terms of your sort of the investment outlook for 2023. I mean, you were a bit cautious, and also obviously there's new data coming in all the time, but what is the underlying scenario that you have? Are you very defensive, or is everything dependent on the inflation outlook? What's your overall view how 2023 will shape up in the Nordics?
I mean, if you look at if you start with on an allocation level, we think that 2023 will be a very good year for the fixed income space, but it could be good depending the next coming months on the equity market. I mean, if the market goes down 10-15% going into year end, which we don't believe, that could create a good setup for the 2023 year. But if the market goes up 10% going into year end, it will be very more difficult. But I mean, looking at the stock market versus company profits, usually the stock markets turn upwards 6 to 9 months before company profits troughs. So if someone can tell me if the company's profits are troughing in 6 months or 9 months or in 12 months, we can adjust according to that. But we think that 2023 will be a tricky year. I mean, what we'd like to see is to see that the negative delta on the inflationary indexes. We would like to see less volatility in order to create a good setup. But currently we have so high volatility in the both higher volatility than in average in the equity space and higher volatility in the fixed income space, which looking at the setup for 2023, we think it will be a tricky year. That's why we think it's beneficial to have an absolute return fund in your portfolio, where you can protect the downside as well as get gain on the upside.
I think that, like I said before, the positioning and both on exposures and cash levels and that is very important, or also in the volatility space. But no one, I think, if you said to someone that the inflation is 10% and you have the macro environment is very bad at the moment, and you gave that to someone and said that Euro stock is only down 10% on the year, I don't think they would believe you. So the positioning and the volatility is very important. That's what's been driving this 15% bounce in the indices. So it's important to look at that as well as that macro environment and the company's earnings going into 2023. But like I said before, the positioning is clearing up, and it looks like a decrease or decline could start here or in Q1, when the positioning and the hedges are cleared up.
So it's interesting also in 2022, the market has been affected by the interest rates coming up, and in 2023 the market could be affected by EPS, and the company's earnings will go down. But depending if they come down 5% or 15%, that will set the stage in 2023.
Okay, thanks a lot. Any more questions on Select?
Yes, I have a specific, well, actually a more general question, sorry. What has been the percentage of foreign ownership in the market historically, and how's that evolved during the last year?
Sure, thank you for that question. So it's been increasing the last 10 years, but we have seen foreign investors selling the Nordic region the last 12 months. So it's been decreasing significantly the last 12 months.
don't have a number, but yeah, around 25%, 20%, and that's declined during the last 12 months.
Yeah, mostly because big investors such as Fidelity and Capital Group and such have been selling quality names and growth names, which is a large part of the Nordic region, I would say.
Okay. If there are no more questions on Select, then I suggest we move on to Target.
Great. So just some quick thoughts on Norron Target, which is our other absolute return fund, which is a Nordic multi-strategy fund. Looking at the performance since inception, so the fund is sort of an involvement of the Catella hedge fund from 2003. So the CIO Ulf Frykhammar has been running this mandate almost the last 20 years. However, and also been posting above 4% of annual returns with a volatility below 4%. So it's a low risk multi-strategy fund where the fund combines different strategies such as unlisted holdings, small caps, high dividend yielding stocks, the directional and beta names such as we had in the Norron Select fund. We're using index hedges on the short book. We have a variance swap. We use single stock short positions. We have a market neutral strategy, and this boils down to the equity gross and equity net. So more sub strategies compared to the Norron Select fund. And also compared to the Norron Select fund, this Norron Target fund holds a large part of fixed income exposure, depending on what type of instruments, but it could be investment grade, could be high yield bonds, and also convertibles. And during the last 12 years, the fixed income exposure has been declining from 60-70% down to 25%. What we have been doing the last 12 months or last 9 months is to increase the fixed income exposure, because all of the sudden there's an alternative to equities, and that's fixed income. The fixed income portfolio in the Norron Target funds is yielding approximately 6-7% on an annual basis. Why not allocate more into that sub strategy? That's our thought right now and our thinking right now in the investment committee. So this is just a short teaser of the Norron Target fund, but what we would like to is to highlight the Norron Select fund, because we think it's a great equity replacement right now. That being said, I think actually we can open up questions for the Norron Target fund and open up more questions in general.
Maybe on the Norron Target, can you elaborate a little bit more on the fixed income part of the portfolio? I mean, there's a lot of corporate bonds in it, high yield loans, or what is it that gives you like 6-7% yield on the fixed income side?
Sure, thank you for that question. So during the last 12 months, we've been having a mix of 50-50 investment grade and high yield. But what we've been doing, as our fixed income PMs are very active in this portfolio as well, they've been allocating away from high yield into investment grade, because now of course you take a more durational risk then, but I mean the rates are 3-4% currently in low risk, and if you go out for taking the H&M and Atlas Copco, for example, a 5-year bond with H&M is yielding 6%. I think the default risk in H&M and Atlas Copco are quite small right now. That's why we're taking on that type of instruments, allocating more into the investment grade space, I would say. But currently we have approximately 50% exposure towards that part of the portfolio.
Other questions on target or more on select?
So, sorry, did you say 50% on aggregates for Norron targets is the exposure in fixed income?
Correct.
Okay. And the rest is equity and the other strategies that you've just highlighted?
Yes. So what we've been doing in the Norron Target Fund is to reducing the risk on the equity side. So we continue to have a low net on the equity side, but to get that positive carry through the fixed income portfolio.
Thank you.
Please go ahead.
Okay, I'm unmuted, yeah. I just wondered how much over the course of this year have you increased the exposure to the fixed income? Where has it gone from to, and what is are you already at your target, or do you expect to go to even more?
So at I would say end of 2021, 2021, we had approximately 27% exposure on the fixed income part. Today we have 50. I would say that within the next 12 months, we will be increasing towards 60-70%. But as there's so high volatility in that space right now, we have been taking a pause with that allocation. So currently we have 50%, and we've been increasing the last 9 months, and I think we will continue increase, but we're taking a pause due to the fact that we would like to see the volatility comes down first in that part. But
the money has come from more or less high dividend yielding stocks, where we see you can get the same yield in IG names on the fixed income side. So that's mainly the reason why.
Yeah. So for example, there's a utility company called Telia in Sweden, and the dividend yield for that equity is approximately 6.5%, but the bond is yielding 5.5-6%. So the risk reward allocating more capital into that Telia bond is more attractive, we think. That's why I've been shifting or allocating money from the high dividend yielding stock into the fixed income exposure.
There's Patrick. Fair. If you got a question, Patrick, go ahead.
Yes, thank you, Stefan. The 5% unlisted exposure in your loan book, what's your general approach to unlisted holdings?
So the unlisted approach, unlisted strategy has been a great strategy for both the Norron Select Fund, but also the Norron Target Fund the last 6-7 years. But as we're not currently allocating money or capital into this strategy, because we think, when market will trough, if it's within 6 months or 9 months, the overall or capital in general will start with the large cap names, then go into mid caps, then go into small caps, and then go into private equity. In a turbulent world, have an easygoing portfolio. That's why we are not allocating more capital currently into the unlisted space. However, we have interesting holdings in this strategy. And if there's a capital need, we will of course support those different companies. But I mean, many VC and PE players has been sort of telling all the underlying portfolio companies to sort of have a new strategy instead of just aim for growth, but aim for more like positive cash flows. And we have seen also many companies reducing workforce and reducing costs. But we pay more attention towards the public investments and monitoring the unlisted holdings and support where we can, but we don't put any more capital into that strategy right now. We would like to keep it at 5%.
You can say that it's a rough number. 5% is actually 2.5. So that's it's not 5%.
And historically, what has been the max?
So we can't go over 10% due to the usage mandate. And also when we take on new investments, we have to have a board approval that the company will either go public or have a sort of structural assessment or structural exit towards a merger or something within 12 months. So or equity financing bridge, for example. So we have to have a new event within 12 months in order to be able to invest in the unlisted space.
And you value those according to the most recent funding round, or? Say again? You value those exposures according to the most recent funding round, or? Yeah. So this is done by our fund admin, and we're not dependent. We can't decide the valuation. It's our fund admin, and we have outsourced the valuation towards them. And I mean, there's some of them are valued at the last round, but as the world is getting more complex and we get more questions from our compliance, we have been reducing the valuation for most of them, but also, I mean, in some of these there's a gray market. There's gray market trading, and that will be considered as well when valuating these companies.
We have been taking markdowns.
Thanks very much.
Yes. So to summarize, we have been taking markdowns on this.
Yeah. Okay. Thanks very much.
Is there another question from the audience? That does not seem to be the case. So in that case, I think we'll wrap it up here. I would like to thank Marcus and Oscar very much for the presentation. It was very interesting. And also for the attendance from all our clients. As I said at the beginning, we have recorded this webinar, and we will send you the link to the recording, including the slides, after this call. Thanks for attending, and everybody have a nice day.
Thank you very much.
Thank you, everyone.
Thank you.
Thank you.